Hey everyone, I'm Shreyans. Today with my colleagues, we are breaking down the economic theme and key indicators. We are also explain Beating the Street by Peter Lynch. Investing well isn't about being the smartest. It's about the staying calm. Market ups and downs are normal. If you let fear or excitement drive you, you will often buy high at mispricing and sell low and lose your money in the market. Instead, stay invested in the market for a long time. Wealth come from the time in the market, not perfect timings. Market dips can be chances to buy good companies at better prices. So don't panic when headline get crazy in the market. Simple works. Only invest in businesses you understand. If you can explain how company make a money in one sentence, you are thinking clearly for that company. Even a group of seventh graders once beat the market by choosing companies they knew. They knew. Checking basic numbers and being patient. The takeaway control fear and greed in the bullish and the bearish market. Stick with the understable companies and the fundamentals of the company and give your money time to grow. That simple approach can beat many professionals over the long run. Investing doesn't have to be complicated. Mutual funds pool many stocks or bonds so you can spread risk as your wish and your wealth. But pick ones with the low fees and a clear strategy and the fundamental strategy also. Stocks can grow a lot over many years, especially if you don't let short-term fear or excitement drive your decision in the market. Staying invested through ups and downs is key. Peter Lynch, a successful investor, showed that everyday research works. When he ran the Magellan Fund in the late 1970s, he focused on company he understood and didn't swap winners for weaker picks just because of market noise. That helped the fund grow strongly in just a few years. The simple lesson: choose things you understand, keep costs low, be patient, and don't panic when market wobble and volatility, and in the market of the bearish and the bullish. The Magellan Fund, which grew to hundreds of stock, required intense research, about 60 to 80 hours of week. He handled this by skimming huge amount of information quickly and taking tiny startup position to keep a track of promising company. He became an early global investor, calling foreign market nightly and buying solid but overlooked firms overseas that focus on strong fundamental and out of favor places led to big profits. In 1987 crash, Magellan was around $10 billion. Lynch was exhausted and tempted to quit from the market, but staying invested meant the fund still ended the year respectively. His key lesson: be patient, even the less traded stock, and let research not fear guide decision. Avoid dying companies whose bonds are collapsed. And remember that your best opportunity may be a stock you already own when its story improves. Now I will hand it over to Mitch.
Thank you, Shyams. So, Peter Lynch, who ran the Magellan Fund, had one big belief: do your own homework. He worked with smart analysts, but he also expected everyone to visit companies, talk to management, and study products themselves. For example, his famous bet on Chrysler came after he dug into the cash reserves and saw huge potential in the launch of the minivan. That research paid off when the company made a big comeback. Magellan grew from $100 million to $1 billion because Lynch kept things simple. His team did weekly 90-second stock pitches, quick and focused updates. Think of it like a Shark Tank pitch, but extremely fast and only about facts. This helped the team stay sharp. He also stabilized the fund by staying diversified into nearly 200 stocks. That means even one or two fails, the whole portfolio stays healthy. Just like how shopkeeper doesn't depend on just one product. If biscuits don't sell, chips will. Lynch's stock picking philosophy was a mix of art, science, and legwork. Art was the intuition, what your gut was saying from your experience. Science was number, analysis, and research. And the legwork was going out and seeing things yourself. For example, if we say that there is a cafe near your home and it's always crowded, that real world observation is legwork. Lynch believed this was more valuable than fancy formulas. He preferred bad markets because that's when good companies became cheap. It's like buying a great branded shoe during a big sale, not because the shoe is bad, but because the market is panicking. But he warned that price alone means nothing. A cheap stock isn't always a bargain, just like a rupees 200 phone charger isn't better than a rupees 700 original one, because quality also matters. Move on to the next slide. Lynch also loved hunting for opportunities in the sector that scared other investors. For example, during the housing crash, he bought companies like Toll Brothers because they had strong balance sheet. It's like buying land cheaply when everyone is afraid, but only if you know the area is genuinely valuable. He also found undervalued plays like Sunbelt Nursery, which traded below book value. That's like buying a shop worth rupees 10 lakh for 7 lakhs simply because people are pessimistic. In retail, Lynch also had a rule: shop like an investor. If you go to a mall and see a store always packed, that's a strong early signal. That's how he spotted big winners like Gap. The logic is simple: if the store is doing well, the company behind it usually will too. His key metric was same and simple: store sales increasing each year. In simple terms, it means are the same shops selling more this year than the previous year? He also preferred companies with low debt and controlled expansion. Imagine there is a restaurant which only opens the new branches when its first or the previous branch becomes profitable. That business usually survives longer. If we take an example, his franchisee bet on Supercuts work because haircuts are a recurring need. So everyone grow hair every month, so demand never stops. Owners earn high returns, and Lynch took this as a simple sign of reliable long-term business. Thank you, and now I will hand it over to Shivam to explaining the rest of the slides.
I want to start with a simple but powerful idea. Great industry don't always create great returns. In fact, industry that look attractive often attract too much competition, which drive profit down. On the other hand, lousy industry tend to push competitor out over time. As bigger player exit, the few companies that remain gain a larger share of a market and stronger pricing power. The company that survive in this tough environment usually have one thing in common. They are the lowest cost operator. For example, Southwest Airlines kept its cost per mile well below industry average. Second, Crown, Cork, and Seal control expenses tightly, spending just a fraction of what competitor did, which helped to protect margin over time. This example highlights two important principles. First, in business, market dominance is more valuable than intense competition. It is often better to control large share of a stable market than a fight over a small margin in a crowded one. Second, firm that focuses on efficient operation rather than flashy presentation usually delivers stronger long-term returns. The key learning is enduring success often comes from disciplined companies operating in tough industry where cost leadership and patience create lasting advantage. Now let's talk about saving and loan sector, which become heavily misunderstood after the SLL crisis. When the crisis hit, the market punished every bank in the sector, the good ones and the bad ones. As a result, strong institutions were suddenly valued as if they were equally risky. For example, People Saving Finance had a very strong equity to asset ratio of 12.5. It was actually safer than JP Morgan, which has a ratio of just over 5. Yet people traded at a discount simply because the entire sector carried a stigma. This shows how fear can create opportunity if we know what to look for. In the industry, bank usually fall into three groups. First, those with poor governance. Second, those that take excessive risks. And third, the disciplined old-fashioned operator that focus on simply residential mortgage and low cost. These disciplined pair are the real survivors. So what set them apart is operational agility, the ability to run with low overhead. High overhead banks like Citicorp at around 3% are often forced into risky loans just to maintain profitability. But banks like Golden West operation at around 1.5% overhead stay profitable without taking big risks. Their cost discipline become a long-term advantage. So the key takeaway is even in travel sector, quality exists, and the best opportunity often come from disciplined company that stay focused on cost, stability, and simple, durable business model. Thank you.
Hi everyone. Today I'll break down two different investing approaches based on the market cycles and inefficiencies. And then we'll look at how to capitalize on troubled utilities and privatization. And then how to time the cyclicals correctly. So, onto the first slide on the left side, uh, this slide outlines two powerful investment approaches. Like we have troubled utility cycle. This is a classic turnaround story. The lesson here is that the best buying opportunities often in phase two, right when the crisis hits and dividends are cut. Like the progression, if you buy when the news is worst and hold through phase three, that is the stabilization, you capture the upside in the phase four. Like this is when the company recovers and has started reinstating the dividends. And the stock price can double or triple as the market realizes the crisis has passed. Like on the right hand side, we have the privatization. Right. Like to summarize this by the quote, whatever the queen is selling it, buy it. Like, these are often rare opportunities because government tend to clean up the balance sheet by absorbing the debt and injecting a lot of capital before selling. You essentially get a monopoly with a fresh start. So this is particularly lucrative in telecom sector and uh, other also, but where we see high growth rates of 20 to 30%. Now, to summarize this, in short, both strategies rely on spotting values where others see uncertainty, either in a utility crisis or a government state. Now, coming on to the slide two, that is of the inefficiencies and cyclicals. First, the master limited partnership. Wall Street often ignores these because they require a lot of tax paperwork. However, this lack of attention creates bargain. Now, the key takeaway here is the cash flow discount. These companies might report low earning, but their actual free cash flow is often massive. If you are willing to do a little lot of paperwork, you get the value. And finally, let's discuss the cyclicals, which is on the right hand side. The companies like autos, steel, or aluminum often tend to behave like how economy do. If they grow, the company also grows. But if the economy is not growing, the company is also not growing. So let's say for a normal stock, a low P is good. But for a cyclical stock, low P is a sell signal. It means the cycle has peaked here and earnings are about to drop. Conversely, the high P means a buy signal. It means earnings have bottomed out here and are about to recover. We can check this up by using the pent-up demand factor, like taking a real-life example of India. In 2006 or 7, there was a highest amount of demand that the India created for truck. And if somebody would have known that the average asset life of a truck is 10 to 12 years, he would have caught the cycle and would have uh, break the pattern by thinking that the demand is going to come in next 10 to 12 years. That is in 2019 or 20. There's going to be a huge demand in commercial vehicles. So he would have made money there. So to summarize this, we can find alpha by buying utilities when they cut dividends, buying state-owned assets when they go private, and buying cyclicals when their P ratios look dangerously high. Thank you.
So the transformation of Federal National Mortgage Association, which is Fannie Mae, was when old Fannie Mae used to borrow short and lend long, which means that it used to borrow short-term loans and it used to lend it for the long term. Holding the long-term mortgages had the risk associated with it about the interest rate. When the rate rose in the mid 1970s, it used to borrow at 18%, which is the short term rate of borrowing was 18%, and the income from the mortgages was about 9%. The earnings of Fannie Mae became very cyclical and very unpredictable, and it had to suffer very huge losses in the high rate years. After this, Fannie Mae had a new model. Suppose you bought a mortgage backed loan from Bank X. Now, Bank X will sell it to the Fannie Mae, and Fannie Mae, with that loan and bundling it with other mortgage backed loan, it will make a bundle of loans and it will be termed as mortgage-backed securities. Now, this mortgage-backed security, either they will keep it by in their own portfolio or they can sell it to the bank themselves who originated those loans. Now, that mitigated the risk of interest rate and it was passed to the mortgage-backed securities buyers. There was another change about matching the long-term borrowings with the long-term lending. They issued 3-year, 5-year, 10-year bonds and they lend it for mortgage-backed securities. Now, because of this new mortgage-backed security model, it is now able to have a stable, predictable fees income. Peter Lynch admits that he missed one of the long-term opportunities, which is mutual fund management companies. The investment logic here was invest in fund managers who earn management fees based on AUM growth. As the AUM grows, the management fees also grows. The cyclical opportunities is when the market correction and exaggeration fears this create the chances to buy strong companies at low P. Here the example given in this chapter was about the Colonial Group where the same price was at the IPO but now it included the 4 per share of cash and with no debt. Performance depends on the interest rate cycle. When the rates are falling, bonds and equity funds are getting favored, and when the interest rate rises, money market players shine. And that's why you should look for unexpected development. Here, the Colonial Group had an example that it secured a good business about marketing funds for State Bank, which started its new fund. Since the 1960s, restaurant chains have become a great growth companies as everyone has started eating outside and that's why it is said putting your money where your mouth is. When you see a restaurant packed daily, that's a real world signal, right? The huge advantage of restaurant is when they expand slowly across geography and they have a strong chain in one region that faces zero competition from another region. Because if two chains that are 200, 2000 miles apart, they don't affect each other. The key driver of success of a restaurant chain is when they have capable management, controlled expansion, low debt, consistent same store sales growth. There are many growth paths like open a new restaurant, improve the old ones, now increasing the high turnover or low price like McDonald's and low turnover and high price like Outback. Now 6-month checkup says you should never buy and forget. This can be dangerous even with the blue chips like Kodak, IBM, etc. The two basic questions to ask yourself is the stock still attractively priced relative to the earning? And what is happening inside the company that the earnings are going so high? Now, as you do a checkup on these companies, if the story is getting better, then increase the investment. If the story is worse or the price is very overvalued, then decrease the investment or sell the investment. And if the story is unchanged, either hold on, look what is going to happen in the future, wait for the fundamental changes or wait for the company to have new changes. And if you think it is going to get better, then increase it. And if you think it is not going to change, then you can decrease or sell the investment. That was all in the book Beating the Street by Peter Lynch.
Gold is a unique and timeless investment. It originally from exploring stars, so it's rare, durable, and doesn't break down over time. All the gold ever mined, about 2 lakh tons, could fit inside a cube that's just 25 meters on each side. That shows how limited and valuable it is. Countries around the world hold gold in their reserve because it provides stability. In 2024, many central banks bought more gold, and India's central banks was the second largest buyer, showing how important gold still is for governments. One reason people invest in gold is that it behaves differently from stocks. For example, in 2010 and 11, when the Indian market Nifty fell by 12%, gold went up about 63%. During the sharp market drop in 2020, stocks fell nearly 38%, while gold rose about 14%. That means Gold can help protect your money and stable your portfolio when stock markets are shaky and volatile. Right now, India's stock market compared to the size of the economy, market cap to GDP is very high, similar to 2007. After 2007, gold went up a lot over the following 5 years. The history suggests that gold might be useful again for protecting wealth if market stay expensive. In 2025, there are many ways to invest in gold depending on what you prefer. Physical gold like coin or jewelry, gold ETFs which traded like shares, gold mutual funds, digital gold platforms, sovereign gold bonds backed by the government. In short, gold is rare, long-lasting, and often hold valuable when other investment fails and volatile. Many investors keep some gold in their portfolio to maintain and stable your portfolio, to add balance and protection, especially during the uncertain times.
Talking about the economic indicators and the effect of rate cuts, let's start on to the left, where we see the RBI's aggressive monetary easing timing. We have seen systematic reduction in the repo rate, with stepping down from 6.25% in February to 5.25% in December. Simultaneously, the CRR has been cut from 3.75% to 3%. Now, talking about the upside and downside, the upside, when you combine this with the massive 1 trillion liquidity injection in the economy, the intent is clear. They want to boost the GDP growth, and it is working to some extent. The increased liquidity has helped our raise our FY26 GDP growth forecast to 7.3%, reinforcing a very optimistic economic outlook. So, talking about the downside, however, this comes at a cost to the banking sector. As you can see here, approximately 61% of the loans are linked to EBLR. Well, this means bank must quickly lower down their earning rates, but their deposit costs fall much lower. This mismatch creates what we call NIM compression, which is net interest margin compression, like squeezing bank profit margin, even as the broader economic expands. Now, going on to the next slide. Now, talking about the market, the macro, the bull case is strong. India has maintained consistent 6% GDP growth for decades while structurally lowering inflation to 4%. And if we talk about demographics, unlike China or Europe, India is only major economy with a working age population that will keep rising for the next 30 years. And if we talk about the financial health, export and remittances are strong. And the reality check, while the Sensex shows massive long-term growth from 100 to 80,000, the current market is split. The Nifty index is at all-time high only because of a few heavyweights. The market breadth is weak, meaning most mid, small, and micro cap stocks are actually down. This explains why individual portfolios may be in red even when the index looks green. Thank you.
Now let's talk about PLI scheme. The Production Linked Incentive Scheme represents a major shift in India's approach to manufacturing. Its goal is not just to increase output, but to build scale, improve competitiveness, and integrate India more deeply into global supply chain. The impact is already visible. India has emerged a major hub for smartphone manufacturing export, including large-scale assembly of global brands. This clearly demonstrates that India can handle high-volume manufacturing when the right policy support and incentive are in place. However, global manufacturing success is built over time. Countries that have scaled successfully invested heavily in supply ecosystem, skilled labor, fast logistics, and consistent policy. For India, the next phase is to move beyond assembling and certain local components, manufacturing technical skills and infrastructure. Recent initiative in batteries manufacturing and uh, rare earth magnet reflects a clear focus on reducing import dependency and securing critical industry. These steps are essential for building long-term resilience. In short, the PLI scheme is not just for short-term incentive program. It is a foundation for creating a strong, self-reliant, and global competitive manufacturing ecosystem that can support sustainable economic growth. Thank you. Now let's talk about AI, artificial intelligence, a technology that is changing how industry and business operate. AI is evolved from basic idea to advanced tool that can learn predict and support decision making. Today, it is powered by large amount of data, strong computing power, and advanced chip. This has made AI useful across many sectors, from improving productivity in office to solving complex problems in healthcare, climate forecasting, and automation. For the IT industry, AI is creating a major shift. Routine and repetitive tasks are reducing while the demand for higher skill is increasing. Companies who adopt AI early and learn how to use it effectively will gain a strong advantage. In particular, firms that adapt quickly can improve efficiency and deliver better outcomes for clients. At the same time, AI also bring risks such as over expectation and rapid technological change. The key is balanced adaptation, using AI as a tool to enhance human capability, not replace it. Overall, AI is not just a technological upgrade, it is a long term productivity and innovation engine for the economy.
China Plus One emerged when companies realized that there is significant risk by having their manufacturing only in the China. This was when they realized there is geopolitical tensions, the wages is rising in the China, the government support from this Chinese government has stopped or reduced, and when the US China conflict have started. China has over 90% of share in the solar batteries, EV and semiconductors, and now companies are looking for other geographies to expand their manufacturing hubs. These locations are India, Vietnam, Mexico, Indonesia, and other emerging markets. But why would companies want to have India as a manufacturing location? This is because of skilled workforce, low cost PLI schemes, and government incentives, improving infrastructure, and we have a large domestic market too. These are the recent India's move that has added to the China Plus One strategy. Now, in India, we are building a self reliant supply chain. The 7,000 crore scheme for rare earth magnets have been launched. The Apple has been deepening its Indian supply chain. The protective tariff on steel imports has also been imposed about 11 to 12% to shield the domestic producer. Now, in the global trade, there has been securing critical resource with new partners like Canada. We are securing for nuclear energy security. There has been reverse trade in pharmaceutical where we import raw material from China and sell them the value-added finished goods back to the market. And lastly, we are also welcoming the FDIs to bring its key technology in India. Now, talking about tariff, US goal was to reduce its trade deficit and it imposed a 50% punitive tariff. Tariff has hit the Indian manufacturing and the PMI in the November was 56.6, which is 3.5-year low. There is also a slowdown in the demand of Indian goods abroad, and that has made the export fall to 13 months low. The GST revenue growth has also slowed down to just 0.7% because now India is more of a demand driven country. The tariff had different impact on different sectors. The sole winner was IT sector because it had no major impact of tariff, while the loser were more import relevant industries which are electronics, chemicals, pharmaceuticals. They were hit by the import cost. Now I may hand over the economic indicator to Meechna.
Thank you, Disha. So let's begin with the core IIP data. So if you look at the core IIP, you will see there is a strong growth in key industries like cement, steel, coal, petroleum products, and natural gas. This clearly shows that India's manufacturing and infrastructure sectors are expanding. Government initiatives like PLI have boosted factory output, and new sectors such as data center EVs are driving electricity demand. So the growth you see in coal and electricity directly reflect that rising demand. Next, notice the CPI and WPI inflation levels. Both are very low right now. WPI is even negative. This is mainly because global prices of metal and oil softened, and India had a strong monsoon, which increased the food supply. And if you see, there's one more supportive factor, which is the stability of the INR. Stability in Indian rupee makes import cheaper, especially electronic, chemicals, and industrial raw materials, helping companies keep their cost under control. But there is one risk we should keep in mind: global tariff, especially the US tariff. If major countries increase tariff, global crisis rises. And since India imports many raw materials from the foreign countries, this can create imported inflation. And imported inflation is not healthy for the economy. It can even force the RBI to delay the rate cuts. So, if in simple words we say that inflation is low right now, but global shocks can quickly change that. So, now let's move to the next slide. So, if we look at the table on top, money supply M3 has been rising steadily each month. When more money enters the system, inflation should go up. But in India's case, inflation has stayed stable. This shows that the RBI has managed liquidity very effectively and the economy is absorbing the extra money without overheating. The next important indicator is credit growth. Non-food credit is increasing, which means businesses are borrowing more for expansion. At the same time, if you see at the bond yields, whether the 91 days T-bill or the 10-year G-Secs, these have remained stable. Usually, when borrowing rises, the interest rate also jumps, but that's not happening here, which reflects the strong economic confidence. For this, let's imagine a shopkeeper borrowing to expand his shop. But if interest rates are stable, he feels confident to borrow. That's exactly the situation at the macroeconomic level. And finally, on the right, we can also see the GDP rising consistently quarter on quarter. This shows that India's economic engine continues to move forward smoothly despite the global uncertainty.